Welcome, folks, to the RESI panel on life science, angel investing, and family offices. We have today a panel of folks, including Alexandra Manick from Schooner's Capital, Paul Russo from Kaito, Sherry Griswood from Fox Hill Asset Management, David Abraham from Sky Ventures, and myself from Mid-Atlantic BioAngels. So, folks, before we begin, perhaps you want to give a brief introduction about yourself. Alexandra, would you start us off, please?
Yeah, hi. My name's Alex Manick, and I work for a Boston-based family office called Schooner Capital. Schooner was actually founded in 1971 by a man named Vin Ryan in order to finance and build Iron Mountain, which you might have seen the trucks driving around, is a multi-billion-dollar global records management company. And while the firm's strategy has evolved over the 50 some odd years it's been around, we've always had the same very general focus, which is looking for exceptional entrepreneurs with some kind of unfair competitive advantage in whatever sector or stage we happen to find them. I personally focus on early stage VC, mostly in healthcare. I was a material scientist in a previous life, have an MBA from Stanford, and have been at Schooner Capital since. Within healthcare, practically speaking, we'll look at anything from healthcare IT to life science tools to diagnostics and therapeutics, as well as companies that sit at the intersection of those areas. Typical check size is $2 to $5 million, but we can be fairly flexible, like to take an active role in our companies, take a board seat, and since we're not on a fundraising cycle, can be very patient, take a long-term view, which we find advantageous in life science and healthcare.
Great, thank you. Paul, do you want to tell us about your group?
Sure.
Yeah, about your group.
Oh, sure. Yeah. I've been around a long time, many decades, primarily in high tech. I've started many semiconductor companies. When the world went from those big fat displays in your desk to the flat ones, we had a chip in every display, big IPO in '98. I've been also doing angel investing for several decades. Last 5-6 years, I've been literally full-time with startups, very active member of Band of Angels, active in Kretzer Forum, other groups worldwide. Keto was started 3.5 years ago with the idea to create a vehicle, an investment vehicle, basically a startup index where we try and identify the top 1-2% of startups. We're agnostic as to industry. We're about 2/3 life science, but that just worked out that way. We're agnostic as to industry and geography. We like to invest very early stage. And so we have a dual vetting process where we literally find, by working with other angel groups, the top 1 company in 50 to invest in. And we roll all these assets into a public entity, so you have liquidity. We're currently not letting our stock trade. We're doing, in fact, an IPO later this year to raise $25 million and resume trading of the stock and uplist the NASDAQ. But for now, we're raising money as preferred shares. So we solved the liquidity issue of startups, and we solved the selection process where we identify the top 1-2% of companies. We have 31 investments so far since we started investing a little over 2 years ago.
Thank you, Paul. Sherry, do you want to tell us a little bit more about yourself and your group?
Absolutely. I'm Sherry Griswood. I'm Senior Investment Officer for Fox Hill Asset Management. Fox Hill is a single-family office co-located in Maryland, New Jersey. We've been in operation officially just shy of 3 years. As a small fund, we've taken a bit of a hybrid approach. We do a limited number, opportunity by opportunity, private investments, and we augment performance with micro-cap and small-cap public investments where we can do open market transactions. We are 100% life science focused, agnostic most of the time with regard to whether it's biotherapeutics, whether it's a device or diagnostics. Because of our size, we really try to cherry pick opportunities at the particular time. So we don't have a particular mandate in terms of the split among those 3 subsectors. By background, I've been an analyst and an investment banker for as Paul said, decades of life on Wall Street. So I bring a deep knowledge of how to proceed with due diligence. We look for opportunities that have some validation in that it's not a single inventor, single lab, single target. We like to see some validation with outside research or research around the pathway from other independent labs. We are past seed stage. Seed stage is just a little too early for us, and we don't have the capacity to fund all the way through a Series C, say, as an example. So our sweet spot is in that Series A, Series B, depending upon whether it's a device. We prefer to see devices that are near ready for first in man. Biotherapeutics, it really depends upon the specific indication. And we look for transformative and highly disruptive technologies. The four siblings that are part of the family office have wanted to give something back, so they've been very interested in looking at out-of-box kinds of opportunities. So we look at devices that can supplant the use of drugs. We look at opportunities that are addressing or attempting to address root causes of diseases where most therapies have been palliative or integrative. And we stay away from markets that are highly complex with a lot of different solutions. Diabetes is an example.
Thank you. David, can you tell us about yourself and your group, please?
Sure. So my name is David Abraham. I'm a member of Sky Ventures, have been for a few years now. My background is primarily biotech and drug development. And that turns out to be a significant element of the Sky Ventures investments as well. Sky Ventures is a sort of a hybrid angel group in the sense that there's about 100 to 150 individual angel members of the group, but we also partner with family offices, microfunds, and strategics who are members of Sky Ventures in the deal flow that moves through Sky Ventures. We see up to about somewhere between 2,000 to 2,500 opportunities a year. Winnow that down through a process to approximately between 12 to 20 companies that actually present at the meetings, which are taking place once every 6 weeks or so. And then from there, individual angels move through a diligence process and decide on investments. Investments that seem to work well at Sky Ventures tend to be those that are a little bit past sort of the very first seed round. In other words, they have some degree of operating experience, and those that tend not to be needing substantial amounts of dilutive capital afterwards, after the initial angel round. We do look to go into follow-ons, but we don't have the same follow-on capacity that, for example, a large institutional investor with a $500 million fund would be. That's Sky Ventures.
Thank you very much.
Sure.
So just a bit background about myself. My name is Yaniv Sneor. I'm one of the founders of Mid-Atlantic BioAngels. Myself originally started in the physics area, but went on to become an entrepreneur and have started and turned around, bought, sold companies for many, many years. And then about 8 years ago, started Mid-Atlantic BioAngels with 2 other partners. We invest exclusively in therapeutics, devices, and diagnostic companies all over the world. We are looking for companies that are in a commercial stage, so we're not looking to fund scientists or science projects. We're limited to the therapeutic areas that, therapeutics, devices, diagnostics, but we don't do anything that's digital or healthcare IT, etc. We're looking for the areas with a lot of IP in those areas. We do not have any geographic limitations. We look for companies that will not require more than about $15 or $20 million in total before they can reach an exit, because we think that if they need more than that, then they're more of a candidate for institutional funding, and so we would direct them to those kind of funding sources if that's what they need. We're looking for our investment horizons pretty much 5 to 7 years. So good. So it's good to get to know all of you. Can you tell us a little bit more about, perhaps Sherry, we'll start with you, about the current funding landscape in your area, and what are the recent changes that you saw, and perhaps some of the trends that you see moving forward?
Sure. Since we are 100% life science focused, I think what I have seen lately, and this may be in response to the pandemic, is more opportunities in med tech at the moment. I think that the clouding of timelines to clinical trials is making it more difficult for preclinical and pre-IND filing opportunities to have a clarity as to when clinical trial routines will be more normalized. So I think that that's one change we're seeing. The second change we're seeing is we're looking at opportunities where there's a finite amount of infrastructure and in fact maybe more virtual than we might have looked at before. This kind of eliminates some of the potential risks that may come from having a more populated or person resource-based company in light of how we're going to move forward and moving out of this pandemic situation. So we're looking at companies that are resource efficient, mostly virtual, and that don't have clinical trial exposure in the viewpoint that they are in the middle of early stage trials or have IRBs that are pending. So we've kind of moved a little bit upstream on the bio area to stay away from clinical trial disruption, and we've moved a little bit downstream in med tech because we think there's opportunities for capital. We think that's an area where capital will flow quickly.
David, what do you think about what do you see currently in terms of the landscape of funding in your area and changes, et cetera?
Sure. So, and thank you. So we're sort of a bit more agnostic, I think, than we, in this context, in the sense that we don't see that, we don't think that COVID-19 is going to cause clinical trials to stop for forever. Certainly if it's something where it's late stage and you're looking for a pivotal and approval as part of your original business plan in the second half of the year, that's going to cause a certain degree of skepticism. Most of the companies that we see coming through for angel investment have already factored into their plans the effects of COVID-19. And so the overall hypothesis tends to take that into account. Certainly if somebody came through and didn't, was saying we're going to start a bunch of clinical trials and they're going to be crucial, I think that would tend to cause some pushback, particularly in the earlier stages when the companies are getting groomed for presenting in the major meetings, to sort of think hard about what you're saying, because people are not going to be particularly excited about seeing this kind of a COVID vulnerable plan. On the other hand, a lot of folks are actually proactively noting how their business model is COVID-19 robust, or alternatively has certain advantages in a COVID world, so that they're able to see a potential competitive advantage or some sort of other benefit, and articulating that to investors. So in general, the deal flow that we see when we sort of look at the top, I guess, what is it, top 1 or 2, or top 1 to 10%, most of those entrepreneurs have already figured all this stuff out, have a storyline that they're presenting, and we're sort of evaluating that. Plus, to be honest, what happens afterwards as the world sort of reopens, how are they going to be able to shift to something that's going to be sustainable in a longer intermediate term, so that they're able to generate an exit or some sort of return for investors.
Thank you, David.
Sure.
Paul, do you have any comments, any thoughts about the current funding landscape?
Sure. In fact, let me give you kind of 3 different perspectives. First, our own funding, because Quito, of course, raises money and most of it gets reinvested into startups. We were in great shape early March. I was in New York and planes were full, city was bustling, had 800,000 commitments from investors, and suddenly when the car hit the tree, that all went away for a while. Now we're raising money again and investing again. So our own world is going a bit more slowly, because a lot of the angel investors or credit investors that invest in Quito and family offices are taking a wait and see attitude. So that's slowing us down. Our own portfolio survived the thing pretty well. In fact, probably 8 of our companies are getting benefits from the government because of the COVID. New investments, we're seeing more deal flow than we could ever imagine. I probably get 3-4 emails a day from people looking for money. I think the reality today is that there's going to be pressure on valuations. And a lot of especially early stage, first time CEOs who haven't been through any of these cycles are not accepting the fact that valuations are going to be constrained a bit, and new funding is going to be a bit more challenging. And so I think a lot of the startups who are not top tier are going to go out of business in the next 6 to 9 months.
Thank you. Alex, what do you see in terms of your area?
Yeah, I'd echo a lot of the sentiments I've heard so far. I'd say, the good news is that PE, VC firms, family offices were sitting on record dry powder before all this happened. So unless the angel or firms LPs base got killed in the public markets in March, which does happen, there is still money looking to find a home. I do think that diligence is taking longer. We're taking more time, being more thorough because we can be. Completely agree on the point of downward pressure in valuations. I think sentiment in the community was that things were way overvalued before, and they're starting to rationalize now. And so entrepreneur expectations are going to have to change and adapt. I've seen, and I'd be interested to hear Sherry talk more about this, but I believe crossover funds, both firms that look at both public and private markets, maybe spending a little more time on the public opportunities now, given volatility, maybe an opportunity to pick up distressed asset, which means that we've seen a little less competition for private opportunities, private investment opportunities in the family office world, which has been good for us. And then finally, we haven't talked about it much, but the farmer partnerships, I think, seem to be happening a little bit earlier, and for therapeutic companies and for lower upfront fees, just because cash is more scarce, more valuable, or at least perceived to be, and valuations are trending downward. So we're seeing some companies pursue pharma partnerships earlier in their life cycle than maybe they would have it a year or two ago.
Thank you, Alex. So maybe picking up one of the points that you said that all of these firms, including yours, have been sitting on a lot of dry powder. So the question of whether there is cash to support early stage companies, I assume there is, and there is quite a bit of it.
Yeah, I mean, a lot of that is public information. You can see the amount that PE VC firms have raised. Family offices are a little bit harder to know what's going on. That's anecdotal. But I think a lot of people were preparing for some kind of storm, and especially firms that are on, a traditional 10-year cycle, they have to deploy the money. Healthcare is perceived to be in some ways, a little less correlated with broader market fluctuations. So it's not a bad place to be right now.
Sherry, how about you? Do you have the dry powder?
We are following Alex's comments about longer due diligence cycle, adding more atypical things to our due diligence checklist. We also agree that this is going to be a tough time for first-time CEOs. We're looking for experience. But I also agree with Alex that there was plenty of dry powder coming into this pandemic. And I think for those of us who've been around through a couple of these cataclysms, we know that there is substantial opportunity in deploying that capital at very attractive prices or valuations. So I think Paul is right in saying that there's going to be significant downward pressure on valuation to account for pandemic risk. But at the same time, it's going to be opportunity for those of us who weren't fully invested coming into it. And I think that's going to contribute to quite a surge in activity once the general population gets some feeling of stability.
Right. So David, since I think you're not so much of a fund, but more of a group, and money sort of coalesces around opportunities, is there money to invest in early stage company right now from your group?
Yeah, so I think that folks are still looking to invest. Remember that we think we've talked about this on a couple of previous RESI panels. So it's really sort of an eclectic group that funnels through Sky. So there might be individual investors, there might be a microfund, family office, like for example, Alex, and also strategics. And so, a number of these folks get up every morning and they need to advance their particular agenda. And so I think we're seeing certain in the context of diligence, trying to make sure that folks are aware, entrepreneurs are aware, they're facing a different operating environment, and their plans need to take that into account. But I don't know that there's a substantial difference in pace. I'd also noted that this biotech at this moment is in a slightly different, and to a certain extension for that, slightly different environment historically. So for those of us who've been around for a little while, you can recall times when, good times or bad times, biotech and life sciences was essentially bad times, right? So you would see maybe an uptick in general early stage investment environments, but they would somehow conspicuously neglect to include an uptick in capital flow into life sciences. I think that has changed, and I don't think that change is necessarily sort of unwound completely. The biotech trade, particularly sort of in the 2013, 2014, 2015 timeframe, saw a substantial amount of flow in and an opening of the IPO markets. And so that attracted a fair amount of later stage capital. So beyond sort of where we would normally fit in terms of the angel sector. And so it's been driving a lot of talent, capital, and interest into life sciences as a whole. And so the level of innovation and the quality of the potential sort of investment landscape is better now than I think it was 5, 6, 7, 8 years ago. And certainly the economic repercussions of the pandemic, and I see those as being more profound, frankly, than the pandemic itself. The economic repercussions, we're still going to have to work through that. But there's a certain element of optimism that I'm hearing generally in terms of life sciences investment, and it flows through to Sky as well. There's an interest in seeing, what we're going to be able to do and how we're going to be able to do it. And that's on top of a fair amount of government money that's actually flowing into companies that we tend to invest in to directly treat or address COVID-19.
Thank you, David. Paul, anything to add to this before we move on to sort of something different?
No, but as Sherry pointed out, people that have been around through a few cycles know that this shall pass, and this is actually one of the best times to invest. Just give you a simple illustration. We also invest in Canada and Israel. We find that on a comparative basis, valuations outside of California, or let's say the US in general, but especially California, valuations are much more reasonable than most of the rest of the world. And so we are very sensitive to valuations because it affects returns and exit strategies. And I think it's going to be a tougher time for inexperienced CEOs, but a good time if you have dry powder.
So thank you for all of that. Moving on for perhaps a different subject a little bit. They say the best way to catch a fish is to think like one. What do you want entrepreneurs to know about your group or about you, or how best what should they understand about your group specifically? Since we're talking to you, Paul, do you want to pick that up?
Sure, absolutely. So one of the biggest mistakes people make, young CEOs make when they talk to investors, is stressing the technology and the coolness. And due diligence will sort that out. The kind of things that we look for is the CEO, plus if they're first-time CEOs, certainly the advisors and board members. We like to look at who are the main investors. Are they smart money or just less smart money? We like them to think through not just what their IP is, but how will their IP fare in 3 years? The challenge isn't, oh, we have this patent now. Well, how easy is it to get around? What will the people do in 3 years about eating your lunch? And we also like to look at exit strategies. If someone's saying, I'm in biotech and I'm going to take 10 years and raise $100 million, we say, well, okay, that's not for us. If someone says, well, I'm going to go reach my first milestone and then be acquired, then that starts making sense as a biotech. So we look at exit strategy, and we're very valuation sensitive. We've gone away from deals that we thought were too rich.
Alex, what do you want entrepreneurs to know about your group?
I agree with everything Paul said, so I won't belabor the point too much, but especially early stage companies, the team is absolutely critical. And this notion of understanding the broader competitive landscape and market landscape is a super important one. Scientists, founders are, can be very focused on the research and underlying technology, rightly so, but what separates the wheat from the chaff is that sort of higher level market awareness. What are the other players doing? Where do you fit into this landscape? If you're a device, you need to understand reimbursement backwards and forwards down to the individual CPT code and how CMS might view you in the future. For a therapeutic, it could be, understanding every clinical trial that's out there for your indication, and explain, not just this, like the cool technology, but, how you're going to win in this market, and why there's a place for you in it. I think, just shows a more experienced and well-rounded CEO. I'll also add to the notion of IP. It's important and it has to be there. But founders will sometimes, index too heavily on that when it comes to differentiation and competitive advantage. Truth is, if an early stage biotech gets locked in a litigation with big pharma, it's only as good as the money to back it up, and the small biotech doesn't have the money to enforce their IP, so you can't lean too much on that crutch. There has to be something else.
David, what do you want entrepreneurs to know about your group?
Sure. So a few things that still kind of amaze me when I see them, because it's in retrospect it seems obvious, but not everybody gets it. Even experienced presenters sometimes don't get it. So to sort of echo, I think what Paul and Alex had mentioned, investors are getting in because they're going to get out, right? So you actually need to be thinking about how you're going to generate return on investment. So I can't tell you how many times folks have come in with a pitch and said, hey, we want to raise angel money, great, and get started, and then we're going to go out and do, to Paul's terms, $100 million round. I'm like, well, so where do you think that leaves us in terms of how we're going to get a return? Understand the value for your company. That's awesome. But if you want our money, then you really need to be addressing our interests as part of your process. It doesn't have to be all of your process. I mean, your process is to grow your company, but what's in it for us, and how are you going to convince us? And so that concept of trying to be persuasive doesn't necessarily resonate with all the folks who want to be entrepreneurs. I'm seeing Alex nodding her head yes, so I mean, it must be on something, which is good.
Yeah, we're all nodding. We're all nodding, David. We're with
fair
you.
enough.
We're singing the tune.
Zoom just put her face up there. That's all I have to say. So I think the next thing that was actually, it was stunning to me when I first realized this in the context of angel investing, but I've since seen it and experienced it amongst a wide swath of investors, is that there's a micro focus on the presenter. Usually it's the CEO, but it can sometimes be somebody else from the company that's sort of the key presenter. There's a micro focus on how they're actually handling themselves. And it has absolutely nothing to do with the substantive message of the company. Because I've seen several investments where I thought, wow, this is really cool. And this could be a real interesting moneymaker. And I sat in a room with other angel investors discussing this afterwards. They're like, nah, I didn't believe the CEO. I'm like, what are you talking about? I said, well, the way they answered this question. And it's like, but what about the rest of all this? It's like, they didn't care. And it's important to recognize that, at least in the angel groups that I participate in, I'm in an angel group because I want to get the benefit of sort of the community. I don't want to be a lone ranger in my investment activities. And so if you turn off enough people, even though I'm excited about what you're talking about, I'm probably not going to move forward because, again, not a lone ranger, right? So it's that affect, it's how you communicate, it's how you answer questions in that 20 minutes that you're pitching. That's absolutely key. And a lot of folks don't get that. Final thing has to do, again, with how you're communicating, how you're reaching out, how you're thinking through the overall sort of investment strategy. And to Paul's point, and I think we've mentioned it as well otherwise, when you're thinking about valuation for some of the sort of for drug development, things like that, not a huge issue to start with, largely because you have to raise obscene amounts of capital. If you're looking at trying to be operating as an angel asset, right? An angel asset, separate asset class from large institutional VC. You really do have to think about what your plan is, and sort of ripping off my first point. Understand how you're communicating and your capital needs and your overall financials. Everybody sort of sees that as being absolutely crucial. Really
David,
does make a difference.
you're having issues with your microphone, by the way, so
I'm sorry, I don't know how to fix that, but I can be quiet.
No, don't be quiet. We don't want to do that. Sherry, I'd like you to ask the same question, and then I want to lead you off with another question to follow up with that. But what do you want people to understand about your group?
Yes. The first thing is, and Alex summarized some of these points, but we will do a certain amount of due diligence even before we have a meeting. So we look at two things in particular. I call it peripheral vision by management. What we don't want to hear is we're the only one, nobody can do this, because by the time the company gets to executing part of the plan, somebody else is also going to be doing it. So we look for entrepreneurs and management who are well-versed in the collateral businesses around them, and it may not even be an exact direct competitor. The second thing that our group is particular about is don't show us the hockey stick financials. I've spent my entire career being an analyst and an investment banker, and I don't think I have found a single company who lived up to the hockey stick financials. I'd rather see either a scenario analysis for the first 2 years or some bracketing around different situations which may impact those. And we don't even look at 5-year financials if the company is not in an operating basis. So we really are focused on management's ability to execute. And that goes to the skill set that the team brings together. We prefer not all the skills to be in one individual. We like to see some broadening of management away from a single individual doing everything. We think that's really important when there are changes in the business, so there have to be shifts in strategy, that there should be a collective skill set within management to make those appropriate decisions. And the final thing is we are particular about having at least one patent issued. We are so small, we don't want to take the risk of investing on an application when we know firsthand how long the process it takes, and without doing a full freedom to operate analysis, which most companies can't afford to do, it's too difficult in some of the sectors we look at to ascertain whether a patent application will ever go to the point of being granted and issued.
Thank you, Sherry. I want to start and ask you another question. You working with a family office. Family offices obviously have a mandate to invest and to deploy that capital, but also they want to sort of shield themselves from a lot of companies, a lot of people trying to go after them for money. How do you find those deals? How do you source? How do you put yourself out there to look for the opportunities? Can you walk us through that process, please?
Sure. Because we're a small family office, it's easy for us to get inundated. So we do two things. One is we don't advertise our phone number very much. None of the family members are visible. They prefer to stay that way. I act as the gatekeeper and contact person. And from my years of being in the business, I go primarily to conferences and academic meetings, as well as look at some referrals. Generally, by the time I get, and it depends upon who's referring and the source, whether I'll take a look at it or not. But I was always sort of an outbound thinker, in the sense that I could find opportunities I felt were higher quality if I approached them, instead of having worked for an investment bank that would look at the deal after 16 other companies got it. It was different to be at the bottom of the list as you got a referral than when you go out and you get the top pick, because you can pick a profile and go look for the opportunities that meet your profile. So I use academic meetings. I do a lot of looking at references in papers if the company is a biotech company, to look for other competitors in the space. I do a lot of group thinking around specific subsegments. So I will look at 6 or 7 companies in the same subsegment because it will answer a lot of questions very efficiently. So primarily academic meetings and conferences.
But you're more looking out as opposed to expecting deals coming in. You're sourcing yourself, you're doing the research.
The issue really there is time management and the ability to give the right opportunities the right view. If I accepted and open up my entire network to just referring opportunities to me, I would not be able to get anything done because it'd be overwhelming.
Got it. Alex, do you go out looking for deals? Do deals find you?
Yeah,
how does it work?
It's a mixture of both. Completely agree that cold outreach is usually far more effective and efficient than cold inbound. I'd say the only one I'd add, because we've been around such a long time, referrals from our portfolio companies or from CEOs we've backed in the past, or co-investors we've had in the past. That's always a really great pipeline. And so, family offices aren't necessarily the best at marketing themselves, and that's often by design. But I think often if you can get to a portfolio company of a family office or someone they've co-invested with, that's a great way to get in. So that's sort of those second degree or third degree connections. And then the thing I'd add, which you mentioned about protecting capital, and I should have said before, is we definitely do look at, probably more so than traditional VCs, we look at, downside protection. Is the capital safe in every single name we look at, not just at the portfolio view? So that's also something for founders to keep in mind as they approach us.
What do you mean by that?
Just, can we get, how protected is the downside? Is this if it fails, is it going to be a total loss of capital, or are there opportunities to get the money out? Another thing we use is the baseball analogy. So yes, the home run has to be there, the potential for a home run, but is there a triple, double, single as well? Are there, less binary exit profile?
Got it. Paul, how do you source your deals, and how do people find you?
I think all the above. For example, RESI, our advisors, and we have 9 life science advisors, are very active in setting up meetings at conferences like RESI and other ones. We have a lot of deal flow through our affiliations. I'm a member of the Band of Angels, a member of the Keiretsu. We have close contacts with many other angel groups globally. We exchange deal flow with them, as you and I might discuss a little later. So we see deal flow from everywhere. We see lots of it. We have advisors that help us filter it. And we tend to have a philosophy where we follow smart money. We have something we call double vetting, where when the Band of Angels says, look at 1,000 deals, invest in 20, we'll start with those 20. We'll do that for other angel groups as well. In some cases, we'll actually find a company we like that has not been thoroughly vetted. We'll sponsor them to one of these angel groups like the Band of Angels. And once they get vetted and invested in, we will then invest. So we get deal flow from everywhere.
Got it. David, how about yourself? How do you source your deals? What's the best way to get in?
Sure. How's the mic working now?
Perfect.
Great. So I'll talk fast and make sure I get it out before it changes. So we do almost all our stuff inbound. I mean, we're fairly well plugged into the life sciences community. So, and as I said, we get 2,000 deals a year. We have a few folks who are making heroic contributions in terms of deal screening. The deal screening committee is like 4 people, including the managing director. And they manage, by now, they can they know when a deal comes in, they can look at it. And the personal record is that I've emailed the managing director with something, and he was able to respond within 2 minutes with a yes or no. And so he just looks at it and like, it's going to be successful, or it's not going to be successful with us. So we're able to move pretty quickly looking at stuff. Because we have such a broad network, we don't really need to sort of prospect. And it just, different people have different funds have different ways of approaching the market. We find that Sky Ventures has enough of brand equity, and our members are diverse enough in their interests that we're able to primarily source inbound and just screen and find the ones that make sense for Sky Ventures and for our companies, our investors, or, I mean, entrepreneurs.
Thank you. Let me just give you a little information about Mid-Atlantic BioAngels. So we invest all over the world, even though our name is Mid-Atlantic BioAngels. We do source deals through a lot of these kind of conferences where it's opportunity for us to meet. And actually, an odd result of the current crisis is that many of these conferences have turned virtual. And so while we wouldn't have a budget and time to fly all over the world for conferences, now we can sit at home and be all over the world in conferences. So our deal flow has actually expanded geographically, where we're meeting with companies from all over the world and are able to actually, our breadth and reach has grown, which is actually interesting. We didn't expect that to be a consequence of the current pandemic. But one of the interesting thing about our group is, as you know, about angel groups, every angel investor has at least one day job. So we really prefer when we get these actually cold calls coming in, the cold applications. We don't have time to speak to people ahead of time. We don't necessarily rely on referrals. We want these people to fill out an application that's very extensive. And then we have a screening committee that's about 15 people large. And they meet on a monthly basis to review all the applications that come in. And then we decide. And let me sort of start up another point, which is about statistics. And I want to hear yours as well. Of every 100 applications that come in, we only invite about 24 of them to present in person. Of those 24, 16 move on to diligence. Of the 16, maybe 2 receive money. David, what is it like with your group in terms of statistics?
Sure. So the numbers that I quoted earlier are somewhere between 2,000 and 2,500 inbound. We see approximately the same number in terms of meetings as Mid-Atlantic does. And we probably fund on the same order, sort of single digits, somewhere between 1 to 5 a year.
Okay. So you're in a sub percentage basis. You're in a 0.5 percentage basis. If you're seeing multiple thousands.
Because of the nature of what we do, we really do see a very large number of variety and quality. And so it's the nature of how the screening process works for Sky.
Alex, statistically?
Similar. We only invest in a small handful of new names per year, so 1 to 4, I would say. And part of that is we do very thorough diligence. We always take a board seat or a board observer seat. So it's a combination of the team's time, the number of investment professionals available to service various names, and just the amount of diligence that we do in each one. So I'd say it's pretty similar. It's 1,000 plus companies that come in per year for a small handful of investments.
So 1-2% yield?
It's less than 1%.
Less than 1%. Sherry, how about your group?
Yeah, I'd say that we're in that less than 1% for a variety of reasons. Again, because we're small, I probably don't look at quite 1,000 a year, but then we really cherry pick very carefully. So we might go a long period of time before we see something that strikes not only the interest in terms of transformative and disruptive, but fits the rest of the profile. And I guess on a percentage base, that's probably less than 0.5%.
Got it. Paul, what's your yield? What does your funnel look like?
Well, it's interesting. We're starting our funnel. Our companies have been already vetted, so our funnel starts with the top 2 or 3%, and of those, we probably invest in maybe 1 in 4. So we hope we're hitting the sub 1%.
Interesting. So Alex, you mentioned that you insist on a board or board observer seat. That's in every deal that you do?
Yes, I think there was. There's some exceptions where, if it's a secondary, we have a really, really small ownership. So there are exceptions to every rule, but for the most part, the primary strategy is, to take a fairly active role, including a board seat or board observer seat.
Paul, what about your group, board seats, et cetera?
We usually, for example, groups like the Band of Angels or other active angel groups, because they're leading the round, they'll typically take a board observer or board seat. We typically don't. Sometimes we're invited to. So I sit on several boards of our companies we invested in, but we don't require that. We'd rather take small positions under 5% in many companies. That's the whole idea of creating a public index for startups.
Okay. Sherry, how involved do you guys get? Do you take a board seat?
We don't require board seats. We look at management and the board around them to make a determination whether we feel we want to be in that position. We like to maintain some flexibility in terms of our independence. So more likely than not, we don't use a board seat to do that. We depend on trying to pick the right management. But there have been instances where we've been offered board seats and accepted them.
Okay. David, how about your group?
So we actually, as a group, don't take a lot of board seats. What winds up happening for us, and it's kind of a corollary of how a lot of these investments come in, a number of our members are already affiliated with the companies as an advisor or a board member or both. And so that's one way that we sort of get some influence or some sort of input into what happens with the company over time. That's a little bit different than some of the other angel groups that I've also been involved with that are more militant about taking a board seat. And I think also by structuring it so that we don't need to take a board seat, it also gives us a bit more flexibility in the range of investments, the type of investments we can consider. So for example, we've been pitched by European firm or European companies, Israeli companies, a variety of other ones that are not located in the Boston area. Since our individual members are pretty much all located in Boston, it's a little tougher for them to sort of have a hands-on early stage relationship as a board member with a company that's in Germany, for example. So it's not part of our DNA to mandate a board seat for an investment.
Yeah, so for our group, we recognize that since, again, we're a group of people and investing their own money, we also invest as pools and we have a sidecar fund, but in essence, it starts off from people investing their own money. A board seat creates a fiduciary responsibility and a legal responsibility of the company, and we don't feel like we can ask anybody to do that. There have been situations when companies have asked us to come into the boards and individual members have to make their own decision whether they want to or not. And then they begin to play an odd role, how much they can say, when they should say things, et cetera, because now they have a responsibility to the company as well. So that's very interesting. I want to ask you a different question. In terms of best practices, what do you want to see from companies to do? So is it a data room? What kind of things really speed up the process and make the investment process successful for you? Paul, do you want to sort of start us off?
Sure. I think for us, I mean, clearly, for me, I got to separate me personally, where I like to see the CEO make a presentation and get a concept and get the idea. But for Quito itself, we like to see someone sophisticated entity that has vetted it and starts with a due diligence package. So our starting point is when someone like the Band of Angels has a due diligence package that's shared with us, is investing, then our own advisors will do some more due diligence. But I personally will sponsor companies. In some cases, I'll sponsor them to the Band of Angels or other angel groups to get them vetted. So I separate myself, where I may also invest as an angel, from Quito, where we want the double vetting.
Alex, best practices for entrepreneurs?
Yeah, a data room is great, but I wouldn't say it's 100% necessary. And often very early companies don't have one, or don't have enough material to have one. For us, it really comes down to making sure companies that are successful, I'd say, are open, trust the investor, and answer questions thoroughly and quickly. If you are a therapeutics or diagnostics company, it is generally okay to ask for an NDA after one or two, well, I'd say necessary to ask for an NDA after 1 or 2 meetings, but after that, you really have to trust and be open and responsive. Investors have really little patience for entrepreneurs who are guarded in their ideas. It makes them look inexperienced, it slows down the whole process, and just generally they're not going to be successful if they can't talk about what they're doing. So really for us, it just comes down to like how quickly and how openly are you furnishing materials in, whatever form they happen to be in, whether that's a data room or a deck or otherwise.
David, any best practices, suggestions, advice you want to give an entrepreneur approaching, you guys?
Sure. So I think that echoing what folks have said so far, but I want to kind of harken back to an earlier an earlier comment that I made around thinking of putting yourself in the investor's shoes. I find that most of the problems that particularly early stage investors have with attracting investment dollars has to be because they don't really think about what an investor is interested in understanding in order to make a decision. They're totally about their business, which absolutely understand and sympathize with, but it's a different mindset and a different skill set to be thinking about what you need to do to raise money. And you do need to think about how you're going to articulate a return. You actually have to even be better at figuring out your investor's business and how they're supposed to be generating a return for their, you know, in terms of their interest, than how you're going to generate a return for your own business if you're going to get them on your side. I think to Alex's point, what you're really trying to do for most of these life sciences businesses is figure out how you're going to make, and it's going to sound a little silly, but how you're going to make friends with the investors, because you're going to be working with these people for, you know, anywhere from 3 to 30 years, depending on what business you're in and how well it goes or how poorly it goes. And so starting off the conversation with that in mind, I think really goes a long ways to understanding how you're going to be able to navigate a process that is, for both sides, frankly, fairly Byzantine.
Sherry, any best practices?
Yes, and once we do a certain amount of peripheral due diligence, we do like to see some detail on a website to start us off. We have the idea that corporate governance needs to start at day one. I can't tell you how many companies that I've met along the way, both in the public and the private sector, that they've been in business 3-4 years, but they can't sort out their governance. They can't get their cap table put together. They've got a bunch of a number of different issuances that all have different terms, but they don't know in summary what all those terms aggregate to. So once we get to a certain level, we're pretty sticky about data room being put together, and we are impressed with companies who know how to do that and understand the importance of good corporate governance from the beginning. After that, it really is execution, talent of management, and you know, that's a judgment call.
Okay, so flipping it on that side, any pet peeves? I mean, I have a few, but David, any pet peeves that you have?
That's an interesting question.
I can revisit you if you'd like.
Yeah, why don't you swing back by me? I want to hear some of the other stuff, probably more interesting than mine.
Okay, well, my pet peeve is partners, founders who are related. I do have an issue with people who are, you know, because I always feel like whenever you bring that business conversation to the home dinner table, especially to the Christmas table or the Thanksgiving table, things can get messy, and people's priorities in terms of what they do in the business change if the people they're dealing with are related to them in some way. So, Alex, any thoughts about your specific pet peeves?
Oh yeah, I'd say, you know, generally arrogance and ignorance are the biggest turnoffs. Strategically, the biggest error we see is people as entrepreneurs, usually first-time entrepreneurs, assuming that all money is the same. It really indicates a level of ignorance on the part of the founder, and people who've, you know, been down this road before generally know that a dysfunctional board or an unaligned investor base can destroy a company. So really, you know, have founders that understand that goes a long way. And I'd say, like, tactically, don't cold email unpersonalized walls of texts. Don't use mail merge, like, ever. It's very, very obvious when we get a mail merge. Too many, you know, adverbs or language that sounds salesy. So like words like stunningly or amazingly, you know, that's just little stylistic things, but you asked for pet peeves. So there you go.
Thank you. Sherry?
I think that in addition to those pet peeves, I think one of our pet peeves is if there's a 15 or 20 minute presentation time, don't take 19 of those minutes to go through the market. Assume that, say, I know the market, move on to what your technology is and how you're going to execute better than the next guy. And that's one of our top ones.
Thank you. Paul, pet peeves?
Yeah, two pet peeves. On the investor side, we've gone through until the car hit the tree here through 12 years of up times, and there's just too much easy money, too much dumb money around. And there's a huge bubble in startups. Everybody wants to be an entrepreneur. It reminds me of 1999 before the world ended. So I have a peeve on too much dumb money, too many dumb startups. And on the entrepreneur side, too little attention to the point that was made by several people, including David. Hey, we invest, we can choose among thousands of deals. Our goal is to do a return on our investment. So focus on exits, return, execution, not so much on how much you love your technology.
Thank you. David, any final thoughts?
Yeah, so I don't know if it's a peeve, but it's just sort of a shake my head kind of thing, right? So it's really understanding that the investment process is about respect. And so if you start from a position of respect, you say, look, getting an investor on your side as an entrepreneur, getting an investor on your side is no different than hiring that killer VP of engineering or that chief scientific officer, with a pedigree and a CV as long as your arm. If you want to get investors, try to actually get to know them before you actually want to get money from them. I don't know if this is even possible, but at least a few people reach out to them and you can even do it on an informational way and just say, look, this may not be the right investment for you right now, but I'd like to talk to you a little bit about, what your objectives are, what your thoughts are. Today it's hard to buy people a cup of coffee, but maybe you get like Zoom for 15 minutes, right? And just say, what are your interests? What are your fund's interests? What are you thinking about? And try to see that as much generating mutual respect and mutual understanding as much as part of your job as developing a killer business, a killer product. So thinking about that respect, I think, is important.
Thank you, David. And I think to echo and to expand on your last point, I think just like we do diligence on companies, they should do diligence on us. They should go to our website, look at our investment criteria, look at the portfolio companies, see the kind of companies that we invest in. I spend most of the time in RESI, et cetera, when I meet with companies, telling them about who we are to make sure that we are the right kind of money for them, so that they wouldn't necessarily have to spend the time filling out our very exhaustive application. So it's, it is, as you said, David, a two-way street, so it's very important. So I think we're out of time, but I really want to thank you all for giving us all of your input and your thoughts. I appreciate it very much. Lovely to spend the time with you and to get to know you. Thank you all.